This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network and Maj Soueidan are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy, sell, short, cover securities in any company mentioned and may profit in the event those securities rise in value if we are long and fall if we are short. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome, everybody, to our next panel at the Planet MicroCap Showcase Virtual. I'm your host for the event, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft, BOBBYKKRAFT. And I'm also the producer of the show, the Avoiding the Crowd podcast with our host, Maj Soueidan. And this is our special episode for this event. And I'd like to introduce, without further ado, the host of the show, Maj Soueidan. Maj, how you doing, man?
Great. Thanks, Bobby. I'm fine. I was a little late night last night, but I'm still here.
Well, good. Well, look, I'm hoping that look, we're recording this on April 13th. Hopefully by the time this is broadcast, you're fully recovered. You never know. You're getting up there. You're getting up there in age, man. Like we can't have these nights anymore.
Just a little bit. Yeah.
Just a few and far between now.
Well, I like most about the With the Crowd podcast is, while it's great learning about these different strategies from different investors across the universe that we've had in our show, MicroCap Universe. I love the pitch session. I love hearing the investors or the guests' war stories, successes, their thought process, how they pick stocks, and some of their current favorite stocks. So I think we decided, hey, why don't we just do a special pitch session on this panel here? It would be awesome. So I'm really excited to hear that, and I'm excited to interview the CEO of a company I'm invested in as part of that pitch session also.
Very cool. Yeah, no. So one thing that we do on every episode of Avoiding the Crowd when we have a guest on is they do a pitch. So we figured we'd pull that segment out of what we do each episode and have 4 investors give their pitch, as well as Maj at the end with the CEO interview. So I mean, let's get into it, right? Enough chit chat, enough banter. I think it's time to get into this. So Maj, you want to introduce our first pitch?
Yeah, the Paul Andreola from Small Cap Discoveries. Multi-bagger expert with Expel.
Multi-bagger.
You're to hopefully follow that up with another one for us, and I can't wait to hear what he has to pitch to us. So he's our first investor.
Very good. Paul, take it away.
Hey, thanks, Bobby. Thanks, Maj. My name is Paul Andreola, and today's company that I'm going to pitch is a company called Vitality Products. Symbol is VPI.V, VPRF in the US. And for disclosure, I am a shareholder of the company. So Vitality Products company that I like to say is punching above its weight class. It's an award-winning line of clean vitamins and supplements marketed to natural health retailers and health-conscious consumers. The company manufactures its products locally here in British Columbia, Canada, and currently sold in 600 stores in Canada and online on Amazon. Following the proven success of the line through repeat orders and same-store sales growth, the company is focused on expanding distribution and growing sales in-store and online, evaluating, researching, and developing new products for future distribution, and exploring new markets for its products. Vitality operates in the health and wellness industry, which of course is an extremely rapidly growing sector. The market size for vitamins and supplements is currently estimated at about $152 billion US, and is estimated to grow at a CAGR of 8.6% to $272 billion by 2028. And the US alone is about $50 billion a year. The company currently has 11 products on the market and sells them through the 600 retailers in Canada, including Whole Foods and Healthy Planet. The company also sells their products, like I mentioned earlier, through Amazon and their own website at vitality.ca. Their leading product is an award-winning iron supplement called Power Iron Plus. Just launched 6 months ago and already is over 50% of the company sales. Now, according to the World Health Organization, iron deficiency is the top nutritional disorder in the world, and it's suggested that as many as 30% of the population have anemia due to prolonged iron deficiency. In the US, iron deficiency anemia is estimated to be an issue for between 2 and 5% of the female population. And so we believe it's vital for a company like Vitality to have a lead product that the company can build brand awareness around and leverage to help introduce new products. Now, the company also has a total of 101 natural product numbers. This means 101 formulations, or in this case, 90 new additional products that have been approved by Health Canada. So the company has no shortage of new products to add to the current lineup. We believe the company is well positioned to be able to grow within the health and wellness sector, and that growth will be attained through expanding product offerings, new territories, including the largest, the US market, new online initiatives, including Amazon, direct to consumer via its own website, and probably the most exciting in our opinion, a new subscription purchase model. So vitamins and supplements offer a category for subscription as it is a regularly consumed product. The customer knows what they need to purchase, offers easy ability to offer new product offerings at point of purchase, and is small and lightweight for shipping. Having established itself in the Canadian health and wellness market, the company is now well poised to invest in marketing. The company is now properly funded to deploy traditional marketing programs. It's interesting to note that Vitality has grown approximately 500% in the last 4 years with almost zero marketing spend. It grew its revenues in 2019 by over $200,000 with the measly $30,000 spent on marketing. Management, the company is female run, which is an important point to consider as most supplement purchases are made by females in households. It's important to understand the decision-making process. Women are more likely than men to take supplements. Most notably, those over 50, where roughly 65% of women use supplements versus 42.5% of men. So the CEO, Cheryl Grant, also has extensive brand building and marketing experience, having worked for TELUS and Best Buy in that role. And the management team has punched holes into retail shelves. And these relationships have been established with the retail leaders. So these relationships will help when they're launching those new products into retail. So as far as revenues, the revenues are small but growing. The company generated just over $200,000 in Q3, which was up 27% from the same period last year, and $600,000 for the first 9 months. And currently, the company has an annual run rate of about $800,000. But it is interesting to note the online sales through Amazon and their online store grew by about 400% in 2020, and we believe this will continue to be a driver of accelerating revenue growth in the future. High gross margins. The company generates roughly 72% gross margins versus an industry average of 36%. And we think that the mix of high gross margins and revenue growth will have a dramatic impact on profit growth. At $800K per year, the company is near break even, and with a small loss in Q3 of about $45,000. The company need only grow by about $70,000 per quarter to reach full break even. The balance sheet is a bit deceiving, because as of Q3, the company had about 2.3 million current liabilities versus only 1 million in current assets. However, 2.1 million of that 2.3 is owed to the largest insiders, which were the family of the CEO and CFO, at zero interest. The balance sheet will be somewhat strengthened as there's a financing that's being closed right now for roughly $1 million. So in our opinion, without that concern of the current liabilities, the new capital is going to be used for marketing inventory, which has stifled their ability to grow in the past. Okay, so the company also owns a 5-acre investment property in Washington State, which is accounted for at cost, but is likely increased significantly in value, and according to management, may be considered for sale at some point to bolster the cash position. Vitality has approximately 2.9 million in tax loss carryforwards, which should help shield future profits from income tax. So the closing price of roughly 28 cents, market cap is 10 million. With the recent financing, market cap will be about 11.6 million. Note that there will be also roughly 9 million warrants, 25 cents, which if exercised is going to add about 2.3 million in cash. And ultimately, fully diluted shares outstanding is roughly 53 million. So in summary, we believe Vitality products offer a strong risk-reward opportunity for risk-tolerant investors. The company is still small, but has reasonably low market cap, has strengthened its balance sheet and raised cash, which will be used to accelerate its revenue growth. It has laid the groundwork for strong potential upside by having gained shelf space in leading retailers across Canada and established a strong brand and recognition in the industry. With high margin products and revenue growth, we should see a strong impact on the bottom line. The company near profitability would result in any excess cash flow helping to increase further growth. So Vitality has several growth opportunities by expanding its product line at very low cost, as many products are approved and ready to launch. It can expand geographically into the large US and international markets, and the company can further grow its online sales through both Amazon and its online store. But perhaps the greatest opportunity we see for growth is the commencement of the subscription model, where the company can capture and leverage a growing long-term revenue stream. So we view Vitality Products shares as a compelling opportunity at current prices. The end.
Thank you, Paul.
Thanks, Bobby.
And Maj, you want to introduce our next investor who's giving their pitch?
Yeah. Hey, thanks, Bobby. Yeah, that will be Andrew Walker from yet another value blog. And love to hear this pitch. I'd love to have him on with the crowd soon too. We haven't had him on yet.
Oh, hell yeah. He's awesome. I had him on Planet Microcap. He's the man. So
that's a prerequisite for being here, Andrew.
All right, Bobby, Maj, thanks so much for having me here. It's great to be here. For those of you who don't know me, I'm Andrew Walker. I'm a portfolio manager at Rangeley Capital, and I run a moderately popular finance blog, yetanothervalueblog.com, as well as an even more, I'm not sure, moderately popular podcast, Yet Another Value Podcast. My podcast is generally centered around people pitching ideas to me, where I'm kind of critiquing, pushing back, learning about it. So it's a little bit different for me to be on the other side of the chair here, but I will try to do my best. The company I want to talk about today is Wide Open West. The ticker is WOW, and I'm hoping that's what all of you think when I'm done with this pitch. Wow, that was amazing, but we'll see. I am a shareholder of WOW. WOW is a cable overbuilder. And a cable overbuilder, it's pretty simple. It is the second cable company that comes into a city, right? So most cities have a Spectrum, which is owned by Charter, or a Comcast, Comcast plus Xfinity, whatever. Most cities have that. A cable overbuilder is going to come in and they're going to compete. They're going to build out a cable network and they're going to compete. So I live in New York City. I get my internet and cable through Spectrum, which Charter owns. But RCN over here has overbuilt New York City. So in my building, I could either get RCN cable or Charter cable. And in addition, New York's kind of unique in that Verizon Fios also overbuilt with fiber. So I actually have three options. Now, overbuilding traditionally is actually an awful business, just terrible. Everyone who has gotten into it has either left or gone bankrupt because the returns, it's just an uneconomic business. This goes back to, for years, Google Fiber was the big scary guy. They were going to roll out, they did Kansas City, a bunch of other places. They were going to take over the country. Google Fiber, Google, the company that prints billions and billions of dollars of cash flow a year, looked at Google Fiber and said, oh my gosh, this is uneconomic. We can't keep doing this. Verizon Fios stopped. AT&T Uverse dramatically slowed. Every cable overbuilder has gone bankrupt. So it is a traditionally awful business to go into. However, with WOW, what I look at here is I look and I say, all right, these assets, ignore that it's costly and too expensive to build this. These assets are built. So let's just go look at WOW as, what are the assets currently earning? Forget about what they cost to build in the past. And I think when you look at WOW today, WOW is extremely cheap. As I am talking, WOW share price is about $13.50 per share, a little bit over $1 billion in market cap, and a little bit over approaching $3.5 billion in enterprise value. This company they did about 440 million EBITDA last year. I think in the next year, we should be looking at about a $500 million EBITDA run rate as they kind of penetrate some of their edge outs and everything. I'll talk about that later. But the bottom line is WOW trades at about 8 times EBITDA. There are no perfect publicly traded peers for WOW. There's only 5 publicly traded cable players. There's WOW, and then there's Cabo, Charter, Comcast, and Altice. The other 4 are not cable overbuilders. They're all pure play cable companies. So there's no cable overbuilder that's publicly traded. However, in the past year, there have been several deals in the cable space. The best deal to compare is Astound, which actually owns RCN, the cable overbuilder I talked about earlier. Astound traded late last year for about 13 times EBITDA. And again, this is the best peer for WOW. They're not a pure play cable overbuilder, but most of their EBITDA is from an overbuilder. And actually, if you listen to Wow's calls, they will frequently let everyone know that they are very aware of the Astound transaction. They think it is a great comp for them. And in fact, they've had discussions internally about selling some of their systems at an Astound-like multiple. So Astound went for 13 times EBITDA. And because Wow was so levered, if you slapped a 13 times EBITDA multiple on Wow, we'd be talking about a $40 per share stock, roughly. We've also seen a couple of other cable assets trade in the past year. Again, these tend to be cable pure plays, not cable overbuilders, but Altice and Cabo both did deals that are at greater than 15 times EBITDA. If you go and you look up in Canada, Shaw Rogers, that deal was struck at a massive premium to the public share price. And even if you look at cable-like assets like Cincinnati Broadband and Alaska Communications in the past year, we've seen bidding wars where infrastructure funds are actually paying huge multiples and huge premiums to get into these assets. So my bottom line is there is demand for Wow as a strategic target. It is very cheap, and if you slapped any type of strategic multiple on them, Wow share price would be up substantially, in part because they're cheap and in part because they're quite levered. And one of the interesting things with Wow is, the CFO and CEO have made very clear they are aware of this public to private discrepancy in multiples, and they would be willing to sell systems to unlock value. So that's my big first takeaway. Wow is cheap. But Wow isn't just cheap. I think both their business and their financials are about to inflect upward. Let me start with their business. Traditionally, cable overbuilders faced a big disadvantage because traditionally cable was about providing video. And when you provide video, the cable company has to go to all the video programmers and negotiate rates. And when Comcast would go to someone like a Discovery or a CBS, they had 30 million video subs. So they could go and negotiate with the strength of 30 million video subs behind them. Wow only has 300,000 video subs. So they're negotiating with literally 1% of the video subs. Wow would have to do higher pricing to every single video provider they had, which means that Comcast, Charter, these guys had a big pricing advantage, right? They negotiated cheaper rates with the video providers. They could pass that cheaper rate to you. So when you went and compared video pricing between Wow and Comcast was cheaper and Comcast had a huge edge there. That goes away in a cord-cutting world going forward. Going forward, we're going to be in a more and more pure-play broadband world where people subscribe to Netflix and everything else on the side. Now it's just Wow versus Comcast for broadband. Both of them have already laid that fiber into your house. There should be no cost advantage for Comcast going forward. So I think Wow is set to, their business is set to inflect upwards because of that trend. Then there's also a financial inflection. The company's cash flow is about to inflect upwards massively. And there's two reasons for that. First, they have a term loan that they priced and they fixed their LIBOR at 2.67%. Anyone who knows what LIBOR is at now, it's a lot lower than that. That hedge, that fixing will come off over the summer. And because they're so levered, that's actually a really dramatic interest expense reduction. It's going to be about $40 million per year in increased cash flow just from this interest expense reduction. Again, this is a $1 billion market cap company with massive NOLs, so they don't pay any taxes. So that $40 million will drop straight to the bottom line. And that is a huge number for a company of Wow size. The second reason that their cash flow is going to increase is because historically they've been focused on edge outs, which is where they take their network and, it's all across New York City, and they edge it out and they add a little bit more of New York City to it. Those haven't done well, again, for all the uneconomic overbuilder reasons we discussed. And the CFO and CEO are committed to reducing those. So from 2017 to 2019, they spent $250 million per year in CapEx. They did $235 million in 2020. I think they can get below $200 million within a year or two. So look, last year, EBITDA was $437 million. Operating cash flow less CapEx was $32 million. This year and next year, I think they'll start approaching $500 million in EBITDA. CapEx comes down from 250 to 200. Interest expense comes down by maybe 50 million as that LIBOR hedge comes off and as they get some natural deleveraging from paying down debt. Bottom line, OCF less CapEx was 32 million last year. I think we're easily going to be approaching 150 million within the next year or two. And so that's the overall thing, $150 million in free cash flow to equity on $1 billion company. That is a lot of equity, a lot of free cash flow. And the last thing I'll mention is in the medium term, I think they're a seller. They have a private equity firm, Crestview, that is a semi-controlling shareholder, owns about a third of the shares. They got involved in 2015. I think they're going to want to sell in the next 2 to 3 years. If you look at their history, they've been very successful with cable assets and with premium sales. I think that's the case here. And I think in the next 2 to 3 years, again, I said an astound multiple would be $40 per share in a sale. I think the next 2 to 3 years, we're looking at a sale. And, I would be very surprised if the number didn't start with a 3, 4, or maybe if this plays out right, 5. So with that, I will toss it back to you guys. Thank you guys so much for having me.
And Maj, who's our next investor pitch for today's episode?
Be Richard Howe. He was a guest on the With the Crowd podcast. And he has a site called stockspinoffinvesting.com. And really love his special situation style of investing and can't wait to hear his pitch.
Very good. Rich, take it away.
Hi, everybody. Thank you for joining me, and thank you to Bobby and Maj for inviting me to present. Really feel honored to be included. Big fans of both Bobby and Maj, so this is awesome. All right, today I'm going to talk about my favorite investment idea. This is actually my largest personal holding. It's a company called Medexis Pharma, and I think it's a very low risk company that could go up many-fold over the next couple of years. So let's get into it. But first, let's cover my disclaimer. So I own the stock. All expressions are subject to change. And basically, this information is just for your informational use only. Yada, yada, yada. Okay, let's get into the actual presentation. Okay, so the basics are Medexis Pharma is a Canadian specialty pharma company. If you look at the right-hand side of the slide, you can see that they've been growing revenue incredibly quickly, and they've just transitioned to profitability. So they were generating very little EBITDA in 2019. They're generating a lot more, over 10 times more, or not quite 10 times more, but significantly more in 2020. And the growth going forward is going to be astronomical. I think they're going to be able to triple or quadruple revenue over the next 3 or 4 years. And so that presents a really interesting opportunity. Okay, so what exactly, let's, take a little bit of a step back and talk about what exactly Medexis Pharma does. So it is essentially a specialty pharma company where they basically focus on buying drugs and licensing drugs that are complementary to one another so that they can use a small specialized sales force to sell those drugs to the same doctors or the same group of doctors, so they get economies of scale. It's a really, really interesting model. In terms of the drugs that are currently in their portfolio, the big ones are Medoject, which is that's sold in Canada. It's an injectable methotrexate drug. So it's injectable methotrexate. You can take methotrexate orally or by injection. This version is an injectable, and it's used to treat rheumatoid arthritis and psoriasis. It's growing about 20% year over year, so a nice grower. Xcity is a hemophilia drug, which I know well because they bought it from Aptivo, which is a company that I know. And it is a drug that last disclosed was growing at about 40% per year. They have ongoing pediatric trials that's going to increase the market size for Xcity by 50%. So a lot of runway to go for Xcity. And then Rupall is another drug, and this is more of just a seasonal allergies drug that's sold in Canada. It is growing year over year at about 43%. And so the portfolio right now is growing incredibly quickly, about 70% in the last quarter. But the big news is that recently the company Medexis announced that they closed another licensing deal where they're going to be licensing this drug right here called Triosulfant. And this is a huge opportunity, which is definitely not reflected in the current share price of Medexis. Okay, so you take the existing portfolio, you add the potential of Triosulfant, and you get to a $350 to $400 million peak revenue potential, which I estimate they're going to hit by 2023, 2024. Guidance from management is that they are going to be in the mid to high 40s EBITDA margin. So just assuming a 40% EBITDA margin gets you to 140 million of EBITDA. There's no capex in this business, so you subtract, whatever you want for taxes, and this business is going to be generating over 100 million of free cash flow starting in probably 2023, 2024 timeframe. So this is incredibly cheap versus their current enterprise value and market cap, as you'll see on the next slide. Let's take a step back. What exactly is Triosulfant? So this is it's basically a conditioning agent for patients that are going to undergo stem cell transplants before they do. It's a conditioning agent given to patients that have MDS or ADS, which are two different types of blood cancers, so that they respond better to stem cell transplants. The benefit of Triosulfant is it has lower side effects, and it has much better efficacy than the current standard of care, Busulfan, which, when it wasn't generic, generated 126 million of sales. So this drug is superior to Busulfan, and Busulfan generated 126 million of sales. And so there's a huge runway for growth for Triosulfan to eventually exceed the peak sales number by Busulfan, because it's going to be used in AMS, AML, or MDS, AML, but also a lot of different conditions, probably more off-label. So long story short, revenue is probably going to triple or quadruple over the next couple of years. This is a business that is going to have very high margins at scale. And so you're going to have an extremely profitable cash generative business with basically no debt. So there's going to be a lot of earnings power looking out a couple of years. Okay, so let's put it all together. The diluted market cap calculation is a little complicated, and this threw me off a little bit when I was initially looking at Medexis. But the way to think about Medexis is on a fully diluted basis. They have debentures outstanding, but those are convertible into common stock at $6.35. The stock's above $6.35. So I'm assuming those debentures are fully converted. There are warrants that are currently range between $2 and $10, but I expect the stock to be significantly higher than $10 by a couple of years. And so I'm assuming that all those warrants are converted, and as a result, Medexis gets some of the cash that those warrant holders would have to give up to exercise those warrants. So if you look on a fully diluted basis, basically this is a company that right now, or looking out a couple of years, is going to, but at the current market price, is going to have a current enterprise value of $244 million. And you compare that to $140 million of EBITDA, which is my 2023 EBITDA, 2023 estimate, and the stock is trading at about 1.7 times EBITDA. What should it trade at? What's a fair multiple? I don't know, but a company that is generating tons of free cash flow, has high barriers to entry, has a very solid business model, it could trade at 15 or 20 times EBITDA. I'm just assuming it trades at 10 times EBITDA. Peers, slower growing peers trade at 16 times EBITDA, but let's just assume it trades at 10 times. 10 times 140 gets you to a $1.4 billion enterprise value. And then if you just run the math and basically, add cash and subtract debt from that $1.4 billion enterprise value, it gets you to a $41 Canadian share price and a $32 US share price. The stock's right now a little bit over 6 on US markets. I'm a US investor, so that's what I own. So, looking out a couple of years, I think this could be, if my estimates are right, this would be a 5-bagger and would be an 84% IRR investment. Again, it's my biggest holding. The nice thing too is, from a risk perspective, I don't think the risks are all very manageable. It's all basically operational risks, which, operational execution, Medexis has to execute well and, sell the drugs that they've licensed, but they're going to be doing that. They have a good track record of doing that. And so that's not a risk that I'm particularly too concerned with. And then the other news is that this is a company that is probably going to be uplisted to the NASDAQ very soon. So that'll be a nice catalyst, because it'll make this company available to be seen from US investors, not just Canadian companies. So that's all I got. I wanted to be brief. I think my time limit is 5 minutes. I probably went over by a little bit, but hopefully not too much. But that's all I got. So thanks again for having me, Bobby. Thanks, Maj. Yeah, so check me out at stockspinoffinvesting.com. I publish a bunch of free content, but if you want my premium content, what I actually own, investment ideas like Medexis, you can subscribe there.
And Maj, last up on our investor pitches, who do we got here?
We got Kelvin Seetoh, also another individual you have on the Win the Crowd podcast. He hasn't been on yet, so I really love his Twitter feed and some of his thoughts and ideas on Twitter. So I'm really excited to hear his pitch.
So everybody enjoy. Kelvin, take it away.
Thank you, Maj. Thank you, Bobby, for inviting me to this small sharing session. And my name is Kelvin Seetoh, and on Twitter you can find me on SlingshotCat. And for today, I'm going to pitch this company called ClearPoint Neuro. And for full disclaimer, I actually own shares in this company. And if you would like to buy this share or sell this share, please consult a financial advisor. This is just for educational purpose only. So let's get straight into it right now. So to introduce the company to all of you, ClearPoint is actually a medical platform device company that enables therapies for the most complex neuro disorders with pinpoint accuracy. So in short, what does it do? It helps neurosurgeons to conduct their surgeries with precise accuracy so that the surgeries can go well and go very smoothly. And second is that the products are being used to perform deep brain stimulation procedures. And finally, this company has a patent portfolio of over 89 issued patents in the United States and over 184 worldwide patents. So let me just share with you the current products that they have. So there are some products that are one-off sale, such as the hardware, which refers to the head frame, the computer workstation, the compatible monitor, and also the software, right? But while it's a one-time sale, occasionally there are maintenance that's required, which forms part of the recurring sale. But what is really the sale? What is really the recurring sales that we are looking for is the accessories, right? Such as a smart frame, controller, and a cannula. So every time a procedure is being done, a new set of smart frame, controller, and cannula is being done. So it's essentially they are following the footsteps of this company called Intuitive Surgical, whereby they are adopting this razor and razor blade revenue model, where we think that the long-term revenue stream sources will be 15% from capital equipment and 85% from single-use disposable and services. So currently, ClearPoint therapy platform is being used in many areas. So first, I just want to talk about their platform. It's very compatible with all major scanners. So Siemens, GE, Philips, these are the common scanners that you see in the operating theaters in hospitals. And the second is that a lot of biotech companies who are attempting to solve some of the world's biggest neuro problems around the world. There are names like PTC Therapeutics. We have names like Lysogen and Charles River. And because they recognize that the value of ClearPoint is to provide that precise accuracy, and they decided to partner up with ClearPoint and to use them to deliver their drugs to the patient. So currently, right now, ClearPoint Technologies platform is already being used in some of the clinical trials already. Okay, so let's move on. So right now, if you look at them, one of the important things to monitor is actually their locations. So currently, they are in 60 centers. Centers could refer to hospitals as well in United States, Canada, and UE as well. So what I want to highlight over here is that if you take notice, right, they are currently in the UC San Francisco, they are in Mayo Clinic, they are in Johns Hopkins University. And these names are really important because these are the names that are the top 10 neuro surgery hospitals. So having a machine in all these hospitals is a form of validation that their technology right now is being used by the top neurosurgeons around United States, Canada, and UE as well. And what's more important is that we do not just look at it from the point of view of the company, but let's hear it from the neurosurgeons as well. So all of them have gave some of the comments about what ClearPoint could do for their procedures. So for example, if you look at the top right-hand corner, Dr. John mentioned that having ClearPoint is to assure accuracy was critical to successful ablation of the tumor. And in the middle is Dr. Mark Richardson. He says that, we are very concerned about changes in distance of millimeter or two. This can be critical. And we want that error to be in order of no more than a milliliter. So that's really no room for error, because just imagine where you are poking into the brain. If you poke the wrong nerve, that could actually create some long-term negative consequences for the well-being of the patient. So knowing where to knowing the location is really critical to get the drug to where the nerve is. All right. So if you look at these reviews, they are saying that ClearPoint has really that added benefit and advantages as compared to other competitors. So as we look at this business, we look at a few growth plans that they have. So number one is to work with more biotech companies to deliver drugs to the patients. And this is what we refer as the biologics and the drug delivery. And second is the deep brain stimulation navigation. So over time, they hope that, more hospitals will use ClearPoint as the platform to, to actually insert electrodes for the deep brain stimulation. And I'll talk about it later on. And the third thing is the new therapy devices. And finally is to expand the footprint, meaning to install more machines in more hospitals around the world. So let's talk about the first pillar of growth that they have. So over here, if you look at it, we have a lot of neuro diseases that we still do not have a cure for. For example, you talk about Parkinson's disease, you talk about glioblastoma, you talk about AADC. So today, a lot of biotech companies, they are attempting to solve this problem. So while they can actually create a drug, but they need a device to deliver the drug right into the brain, right? And not just any parts of the brain, but a precise part of the brain. And this is why they have chosen ClearPoint to be that delivery platform, right? ClearPoint is the platform that helps this biotech deliver the drug into the patient's brain. So if you look at addressable market, it's really huge. I think there's estimate of 1.5 billion market opportunity. So let's move on. Okay. So right now, these are common partners, PTC Therapeutics, Lysogen, Medexis as well. So as all of you know, a drug, once it hits phase 3, most likely it will be commercialized and it will become an official product that patient could use to solve the specific disease that they have. So in this case for PTC, right now they are in trial phase 3. So I think given some time, maybe in second half of this year, they might see a full commercialization. For Lysogen, I think right now it's phase 2 and 3, so it's ongoing and expected to be concluded in year 2022. Then you have Medexis as well, which is currently phase 2B. So what happens is that if any of these 3 or if all of them goes through, and guess what, the patient that could actually use their drugs would definitely increase dramatically, and as a result, they would order more cannula, more smart frames controller from ClearPoint. So ClearPoint does not have to spend a lot of sales and marketing, but they will just get a big burst of orders because all these drugs are being approved by FDA. Okay, so the second pillar that I want to talk about is the deep brain navigation. So today, there are a lot of neurological disorders such as epilepsy, tumor, and also Parkinson's disease. So how do you actually solve them, right? So today, unfortunately, we do not have a long-term solution. We have only a short-term solution, which is implanting electrodes within certain parts of the brain. But how do you pinpoint which are the areas to actually plant the leads? Well, you need a ClearPoint machine to do that, which is why ClearPoint is the one that's providing the navigation for the neurosurgeons so that they know exactly what are the areas to actually plant these leads as well. Okay, so at the end of the day, they can do it while the patient is awake or asleep. So traditionally, they are doing it awake. But just imagine you as a patient having your brain being open while you're awake. That is not really something nice to talk about. So with ClearPoint, it enables a patient to do a sleep deep brain stimulation navigation, and I think that's actually more beneficial for the patient and for the hospital as well. So you look at the total addressable market for deep brain stimulation. I think currently ClearPoint has 7% market share. So this goes to show that there is a huge market out there for ClearPoint to penetrate even further. And I want to talk a little bit more about the laser ablation, which is a new product that they're creating. It is to remove tumors, right? So it's just a laser prop that goes into a targeted part of the brain and using heat to destroy the unwanted cell. Okay, so this is a product that they are releasing in the next few quarters. And I think that in this product, if they're able to do that, then per procedure they're going to earn a lot more money. So for example, right now they're just earning $6,000, which is performing the navigation procedure. But if they are providing the laser as well, then they could potentially earn about $18,000 per case. So that's kind of increasing the revenue that they're going to earn per procedure. All right, so let's move on. So I think the global footprint that they are expecting to grow is that currently they are in US, but they want to grow in Europe. And I think right now they also want to have the capacity to cover approximately over 3,000 cases per year. So that's a huge increase because currently they are just managing somewhere below 1,000 cases, but increasing it by 3 times. That's really huge. All right. So competitors, I think there are a few. One of them is Rosa. But Rosa, I think the downside is that you have to drill 15 holes into the patient brain. Just think about it, right? 15 holes, that's a lot, and that may not be something desirable from the perspective of the patient. There's also another competitor called Medtronic, which is they have this stealth machine, but as we can see, is that they have some problems with it, and there's some concerns from FDA about their product registration feature. So I don't think they are really strong competitors to ClearPoint right now because they have certain aspects which pale in comparison, with ClearPoint Neuro. We talk about the management team. I think Joseph Burnett came in somewhere 2 years ago, close to 2 years ago, and he turned around the company. So right now he has about 3.4% ownership of the company. But what's notable about this gentleman is that when he came into the business, he also brought along his team members from his previous companies. So you can see that in September, August, July, May, he started to bring in his own people into the company. And since then, the business has transformed dramatically, right? In terms of the investor presentations and in terms of the execution ability as well, okay? Valuation, if we look at it currently because of COVID-19, I think the cases that they have done have dropped quite a little bit, but it was bound to increase and recover. And for the biologics, you can see that for the year 2020, it have doubled, right? Have grown more than 100%. I can tell you there are a lot of clinical partners that are dying to use ClearPoint technology because ClearPoint gives them the assurance that the drug will be delivered and administered to the right parts of the brain. So currently they have 25 clinical partners that are working with, and they are likely to expand to 75 partners. What I mean is that right now they have 25 partners, but on top of that, there are 75 potential partners. So just think about the kind of pipeline of customers they have and the kind of visibility and revenue growth that they will expect to receive in the next few years. All right. I think we talk about the market opportunity. Right now, there's more than 55,000 potential neurosurgical procedures that's doing per year. So I think ClearPoint in the long term should be able to capture 10% of the market. And if they're able to do that, I do really see that potentially they are going to earn about $76.3 million in revenue. And also, should any of their clinical trials go through, what I mean is their customers' clinical trial goes through, in terms of revenue potential, in terms of operating profit potential, it's going to be there as well. So we do some illustration. If they capture 10% or 20% of the total addressable market, what kind of revenue they're going to receive, what kind of operating profit that they're going to receive as well. So in terms of the modeling, we are assuming a 30% operating profit margin. All right. Okay. So now let's talk about the valuation, right? So right now, if I'm just looking at the functional navigation revenue, the potential of 76.3 million, we do think that currently the business should be worth about, should have an enterprise value of $686.7 million. But what I'm saying is that in this business, because of the biologics, it represents a lot of embedded call options, or rather we can call it the moonshots. So what I'm saying is that if any of the partners such as PTC, Lysogen, or Medicina goes through, right, and let's say they just capture 10% of the total addressable market, we potentially can see that this business could worth up to $1 billion, right? So now I've come to the end of my short pitch on Neuro ClearPoint. I hope you have enjoyed this short sharing. Thank you, Bobby and Maj.
Hello, this is Maj Soueidan, co-founder of GeoInvesting. Glad to be here at Bobby's event. And, I wanted to give a pitch on a company, Conatel, but I decided, hey, why not better just interview management as part of my pitch? So I have here today Sean McEwen, the CEO of Conatel. For full disclosure, I do own shares of Conatel. I bought the stock in this year, 2021, at around, I think, 40, 50 cents originally. And at some lower prices also. It's interesting. He's in the, Conatel participates in the cloud communication industry. And if you have followed GeoInvesting or myself and some of my investments in the recent years, I've kind of been attracted to this industry, and I own other stocks. So when this came across my plate as a potential company to look at, I was pretty excited. Actually, it came across my plate from Chris Plum, who's a MicroCap investor, and I really appreciate this idea. Was forwarded to me by him. And we wrote an article about the company on GeoInvesting by one of our research contributors, and Glenn Buxamundi. I'm sure I butchered that name, but so we have here Sean today, and so hey, Sean, great to be here. I really love interacting with you over the last several weeks. So let's go right into it.
Awesome. Thanks, Maj.
And why don't you start by giving us, your quick, what do you do?
What do I do? What do we do? In about one sentence, I would say that we're a software company first, meaning that we build and develop our own software applications inside, but we take that software, put it into a cloud format, and through that, we deliver hosted telecommunications and data services for small and medium-sized business.
Great, and I want to get right into the first question that everyone's probably going to have here who follows this industry is how you different. I mean, there's so many different companies in the UCaaS. You got different labels that of different cast labels here. So why don't you go over those? UCaaS, PCaaS, right? Is that right?
Sure. Right.
And talk about where you fit in that and how you're different or complementary to some of these other companies.
Okay. Real quick, UCaaS companies are probably far more prevalent than CPaaS companies. UCaaS, the acronym, our industry is filled with all these acronyms, stands for Unified Communications as a Service, Unified Communications. UCaaS providers typically provide hosted phone systems, voice, SMS systems, where, in fact, if you look behind me on my desk, that desk phone back there, that's a UCaaS hosted PBX or business phone system. CPaaS stands for Communications Platform as a Service. You might think of us as we're the guys behind the curtain, where a UCaaS provider interacts with a customer providing that desk phone in the office. We may in turn, depends on the UCaaS providers, we'll provide the dial tone to them, the phone numbers to them, we'll route the calls, terminate the calls. And we've even morphed over the last couple of years. We started just as CPaaS, but really expanded into more of a generic platform as a service or PaaS company. And when I say PaaS, besides communication, because we also provide data services. So we provide voice, SMS, data, SD-WAN, a whole litany now of services based on the platform that we own. We own a national network with multiple points of presence throughout the United States. So, like I said, kind of the guys behind the curtain, you might say.
Great. So some of the other companies that, let's say, that aren't, in the platform portion of this, they might have a few things here or very, very targeted solutions. And if they wanted to add a solution, I'm going to have to maybe even use someone like you or build a solution themselves or go acquire a company. So you're basically this one-stop kind of solution for maybe even a UCaaS company to add pieces to their platform, right, or to their service offering.
We could, in fact, a UCaaS company could host its voice platform within our larger network. Similar, you might say, to like an Amazon AWS. So we could provide servers to them. They could host that UCaaS platform and highly integrated into our voice, data, and SMS network. I probably didn't even mention we even provide mobile services. So besides fixed line, we provide mobile voice and mobile data solutions. Some people refer to mobile data as IoT, is kind of one of the hot buzzwords there.
A recognizable public company we could compare you to that people would know who they are, a bigger company maybe?
On the CPaaS side, or the voice and messaging, we're similar to Twilio. We provide some of the same voice services as Vonage. We don't currently have a UCaaS offering today, and that's really by design. It's something that we might add in the future, and because we have the platform, it's not as difficult to spin up a UCaaS offering. So those are a couple of companies that people might know of that we're similar to, which is not as big as they are.
Great. So before we get into some of the different revenue sources of your business, now actually there's other pieces of your business too. You have this lifeline business I really want to get into.
Sure.
But why don't you want to give us a little brief kind of elevator pitch on that piece of the business?
Right. So real quick at a high level, we have probably two main segments in the company of hosted services. So those hosted services, what we've been talking about, CPaaS services, platform services, DIP services, and then we have our mobile services. And mobile services includes regular cellular, wholesale, and retail cellular service to small businesses. We don't provide services to consumers. We go after the business market. And within that segment, within mobile services, we have lifeline services, or it's basically what that is cellular service, voice and data service that's subsidized by the government through a program that started in 1984. You could probably trace the roots all the way back to the 1930s, but really 1984, 85, and the Telecommunications Act during that time under President Reagan is when this program started. It was basically a way to provide minimum basic phone service to low-income Americans. It's similar to providing other basic utilities like electricity. And we hold.
Is that like a track phone? Would that be one of those companies?
Track phone is all right. So track phone, it was recently acquired by Verizon. Track phone provides a service to consumers, but they also have a group within them that provides this government subsidized phone service called Lifeline. There are, the count changes from time to time. There are around 11, maybe 12 companies. We're one of them that holds a national wireless Lifeline distribution license. And that license comes from the FCC, the Federal Communications Commission, and the FCC has not issued any new approved Lifeline compliance plan since 2012. So for 9 years, it's basically a moratorium. What that license allows us to go out through the United States and apply to provide Lifeline services at the individual state level. So right now we have the national FCC license that we call that approved compliance plan, and then we have 8 states that we're authorized in today, and so through those 8 states, we go out and provide this cellular voice and data service, and through a fee collected on phone bills, Universal Service Access Charge, I think is the acronym, USAC. The money comes to us carriers to help offset the cost of that service. So that service can be provided at a very low cost. Sometimes depends on the what's bundled. Sometimes at no cost, and it's limited to Americans that meet the threshold for low income, below the low income level. Typically, these would be people that might be receiving food stamps. They might be living in Section 8 housing, and we provide the service for a year. And after a year, if the people still qualify, then they can re-up for another year.
Thank you. Now, in terms of revenue between your segments, can you talk about that a little bit, and especially maybe even break out a Lifeline separately from everything else too?
So I would say we're almost evenly split between mobile services and hosted services. Of the mobile services, or I would say Lifeline in general, accounts for about 21, maybe 22% of our total annual revenue. So we're not depending on it or dependent on it. You could probably say we don't have, all of our eggs in one basket. We have I believe, a really diverse suite of revenues between the hosted services, mobile services, data services, DIP services. There's about 5, maybe 6 main streams of revenue. And with the Lifeline service, is kind of interesting is I look at it as almost a hedge during a downturn in the economy. And we're living through one right now with COVID. And so it's nice to have that revenue stream, especially during a down economic time.
And both your I guess your growth kind of drivers right now were both companies that were I guess acquired, right? You acquired these companies.
Yes. So
a few years ago. So talk about that kind of acquisition strategy and that.
Okay.
Kind of company.
So I can tell you real quick. I started Conatel in 2014 as a cellular reseller. We call that an MVNO, mobile virtual network operator. Companies like TracFone, those are MVNOs. MVNOs, typically we don't own our own cell towers. We'll buy capacity from carriers like AT&T and Verizon and market under our own name. So that's how Conatel started. Then in about 2016, I started to map out a strategy to diversify away from just exclusively cellular. And this is before the company went public. And I wanted to go back to my own roots, my own software development roots. That's an area I understand pretty well, and get into hosted services. I thought it was important for Conatel to own intellectual property, to own its own infrastructure, to have that tangible value. When you're just a reseller, you're buying something for $1 and selling it for $2, and you really don't own that intellectual property. So
and also you have this ability to kind of really guarantee quality and more so than these MVOs and those can too. So you have a much more control of your network, more efficiency in the way it's delivered, I guess, right? And just better quality.
Yes. Kind of deviating then for a second along that question, we refer to this as extending the network to the edge. So Apeiron, that's the hosted services company, and is one of the 2 wholly owned subsidiaries of Conatel. It owns its own national network, and when I say owns it, it owns the computers, the switches, the software. It doesn't own the physical cables in the ground. I don't even companies like AT&T lease cables, not all their cables, but cables and fiber optics through the ground. But by owning our own national network, it allows us to control the quality. And since we can control the quality, we can offer what's called an SLA, or a service level agreement. So by contract, we can give a guaranteed level of service to our customers. Because we own the network, we talk about, and we added SD-WAN, we can now extend our network right to the doorstep of a company, right to their physical location. So it allows us then to extend that SLA right to the doorstep. I know kind of we deviated there for a second, but kind of back to the acquisition strategy. So when Conatel was mapped out that strategy in 2016, part of the strategy was for Conatel to move into becoming a software holding, or a communications and software holding company, to acquire other companies. And that was the purpose for going public. So within the first year, I closed the first 2 acquisitions. One is our hosted services company, Apeiron Systems, and the other one is Infinity Mobile, which is that Lifeline company. And you were asking about Lifeline earlier in that process. It took almost 3 years just to find a Lifeline company we could acquire. And then it took almost a full year just to get FCC approval. You go through a pretty detailed background process. Your company and the people running the company go through a personal background process evaluation. So it was about a 3-year process to acquire Infinity Mobile, and that acquisition was finished in 2018. In fact, both the acquisitions were finished in 2018. We haven't done any acquisitions since for almost 2 years because it took about a year and a half just to incorporate the two acquisitions into the company. We had some cleanup work to do on the Lifeline company, and now that company is actually all our companies are basically debt free now.
Why don't you so yeah, you acquired these in 2018, Perion, like the Lifeline business. Maybe now, can you discuss some of your growth you experienced over the last couple of years?
Yes.
Where you're sitting now, including your 2020 performance.
Okay. Growth first started with moving from negative earnings to positive earnings. So when I talk about cleanup, one of the things we've been doing for the last couple of years is shedding a lot of the low margin business. That took a while to ease out of that business, especially when you're doing.
And that was your MVNO business, basically your legacy business, right? A lot of
it was mostly the wholesale side of the legacy business. Exactly, those were very, very low margins. Some were far below 5%. So that just wasn't the business we wanted to be in. You know, that can be a good business if you have enough volume, but we're after more of the higher margin, direct to small and medium sized business, those opportunities. Because with those opportunities, we can go and bundle services. We can bundle voice, we can bundle data, we can bundle mobile, we can bundle SD-WAN. And when you start bundling these services, your customer becomes a lot more sticky, and you get good high margins. So I don't think I answered that question.
No, that was good. So that's okay. But, we have a lot to talk about in a few minutes.
All right.
I know it's difficult, but thank you, Bobby. So let's go to your 2020 performance where you're sitting right now. Talk about that a little bit, what you accomplished, what you want to accomplish, and I want to really come back to Lifeline because a really big development happened recently in the Lifeline business, which I think has really got me excited.
Okay. So from 2019, so 2019 was from 2019 to 2020. I would say 2020 was kind of the cleanup year. You can tell from revenues went up slightly in 2020, and I think it was about 2.5% increase in top line revenue. And considering the middle of COVID and all the other headwinds that have faced our economy, I think we did pretty well. On the earnings side, I think we knocked it out of the park. Little over 700% improvement from, in rough numbers. I should have like a cheat sheet or something here, but somewhere around about $1.5 million, I think, negative in 2019 to about a quarter million positive in 2020.
One of the interesting things too is like if investors were to look at your numbers on a consolidated revenue basis, they wouldn't see necessarily the growth. But if you look at the individual pieces of the puzzle, like and the most exciting parts of your business, they're growing nicely here.
They are. The big focus was on margin, growing, getting into profitability. Remember, our company is 100% has been growing completely based on cash flow. I am the type of person who's a bit resistant to turning on the printing press and diluting. I'm the largest shareholder of the company, and I certainly don't want to dilute myself along with my fellow shareholders. So instead of doing a raise and diluting at what right now is a pretty low valuation, I believe, we just hunkered down and said, you know what, we're gonna do this manually, the old-fashioned way, through internal growth. So getting to to cash flow positive. First, we got to EBITDA positive, then we got to net income positive and cash flow positive, and shed. There were also some long-term debts, well over $1 million worth of debts. The company has been paying off all those old legacy debts. So today, except for maybe a PPP loan or an EIDL loan through the COVID rescue plan, we're basically wiped out all those debts, cash flow positive, EBITDA positive. Now the focus is on top line. But we needed to get to that profitability, because that's what funds growth. And for us, growth comes from hiring people. That's our number one asset. Other companies have plant and equipment and factories. Our plant and equipment are the people in the company. So that cash flow lets us go out and hire more talent. So that's been the focus. And like I said, we look at the numbers from last year, about 700% increase in net income. Like I said, I wish I had the sheet in front of me. There are a few more.
That's fine, but actually, too, is what I like here too is you kind of gotten to where you've gotten today without really a really aggressive sales and marketing effort. And I think moving forward, you're at that moment now where you're ready to start turning that on. And what's interesting also is, I think, and it's a good segue into Lifeline, is that with some of the developments that are going on in Lifeline business, you're going to get some more cash flow coming in. So you're going to be able to actually probably step up that growth.
So I'll speak to that in sales real quick. It's a little embarrassing to say that we've been growing the company, sit around waiting for the phone to ring. I don't know if you heard the saying in sales, there's two types of salespeople, hunters and farmers. Well, embarrassing to say we've been farmers all this time, just waiting for the crops to grow. We just hired our first full-time true director of channel sales in the company's history. So now it's switching from farmers to hunters and going out and hunting for deals and taking a proactive approach to sales. On the Lifeline side, you mentioned about some of the new things happening there. About 5 weeks ago now, maybe 6 weeks ago, the FCC voted unanimously, all the commissioners voted unanimously to expand and create a new program called the EBB. I think it stands for Emergency Broadband Benefit Program. They allocated $3.2 billion to this program. And
that was kind of tucked into the stimulus bill, right?
It's hard to sometimes track the flow of money in Washington, where the money comes from, and which stimulus bill and which relief bill that's going on. Right, there've been so many. There's trillions of dollars being printed, but I can tell you that about $3.2 billion was allocated. This information is all available publicly to this EBB program, and it's a one-time funding. We don't know if the program will be refunded next year or whenever that $3.2 billion runs out. But in the meantime, what it will do is it'll provide an additional $50, at least for our scenario, an additional $50 per line per month. And this will allow us to go out and bring the service to areas that we couldn't economically serve in the past. We've been offering unlimited voice, text, and data plans for quite a while, for a number of years actually. But there were a number of areas in the country that we just couldn't bring this plan to. The economics didn't work, but now with this extra funding, the economics work. So
it's not only that; it's like a situation where you approved in 8 states.
That's right,
and you're basically only been operating really in one state because of certain things we don't have time to talk about right now.
So we've been operating primarily, not exclusively, but primarily in Oklahoma, and mostly because there's an additional subsidy that comes for tribal areas, for Native Americans.
So now you have so now you can go there, and now you can start going to these other states where the subsidy was not near as big, And now you also have basically maybe more incentive to even go outside these 8 states and more aggressively trying to get more states.
There's no doubt with that, because we have that FCC approved compliance plan, kind of a national license, if you want to call it that. Yes, we'll rapidly push into the other states, but just in the 8 states that were authorized now, I mean, you're talking thousands and potentially thousands of activations per month. There are some Lifeline carriers activating today over 100,000 new lines per month prior to this additional money.
Now, without getting into your pricing internally, but you have X amount of lines already you're servicing. This is just going to be once this is turned up.
Right. So we have about 6,000, almost 6,000 lines now, and
if you take
revenue will increase from $34 to about $84.
Just for doing nothing, basically, just for having these lines.
Well,
right? Basically.
we'll have to provide unlimited data for those lines, but the incremental cost with the extra money, we can deliver the unlimited data, cover those extra incremental costs, and still have some amount left over.
All right, so you basically just you're going to get, before you even go hunting for more.
Right.
You have more lines you already have overnight. You're going to have this potential here to, on a monthly basis, to get this increase in revenue.
Right. Well, we go from $34 to $84.
Yeah. Which obviously can put you in a better position now to go, even maybe be more aggressive in some of your marketing efforts in your Aperion side of the business. So,
well, one of the things, again, I mentioned about building a company from cash flow. The plan is to utilize that positive cash flow from Infinity Mobile, which is we call that an ETC, eligible to communicate telecommunications carrier, and we shift money between the companies as needed. So now that company will have quite a bit of surplus cash each month. We'll use some of that, obviously, to continue to grow that company, to fund its growth, but the true surplus cash will be redirected over to Apeiron. And that money would be used for hiring more staff, sales-related people, and salespeople also means like sales engineers to support the sales channels, to take that more proactive approach. Like I said, hunters versus farmers.
Great. And we're running out of time here.
No problem.
So I want to basically remind people, hey, at Geo Investing, we have a full article on the company and some videos with Sean there to get, if you want to dig deeper into the story. But we need to end up, we've been talking all the bullish things here. We should definitely talk about some of the risks and caveats to investing in your company, Sean, and what are some of the things we need to be aware of on that front? You got customer concentration, other things.
You know a little about my background, spending almost 4 years in the venture capital world. I'm used to being on the other side of the table, the skeptical side of the table, which is, you told me all the good stuff. Now I want to hear about the bad stuff or the risk areas. And so probably the most obvious is, will we execute on the plan? I think probably the greater risk areas are, we have limited resources. When you're self-funded, you have limited resources. So if Lifeline starts to accelerate, like I think it will, we'll need, we can fund that growth several thousand lines a month, no problem, because we have the cash and the cash flow to support that. But let's say that we started hitting 10,000 activations a month, 20,000 activations a month, then I'm going to have to go out and find additional financial resources to support that growth, because you're talking about that could be $1 million or $2 million a month worth of commissions and phones. Now that's obviously a good problem to have, but that's a risk area. Will this new expansion of the emergence of the EBB program, will that be refunded when funding runs out. I don't know. I can't predict what happens in Washington, but there is a backup plan to that. If we sign up 5, 10, 20,000 lines under that program and the funding either is reduced or goes away, we'll go back to the customer base and we'll be able to continue to offer them service, and all they have to do is pay a small co-payment. Attracting good talent. This is a risk area. We're a software company, and so you're competing against Facebook and Google and PayPal and a lot of really big name companies that pay big salaries. That seeking out, retaining good talent, that's a challenge.
Okay, and so overall on the hosted side, is there a specific risk you want to talk about on the hosted side of the business besides that could be what we got to worry about?
On the wholesale side?
The hosted communications.
Oh, hosted. On the hosted side, yes, we have concentration in a couple of key customers. You want to obviously diversify that. Our largest customer, I can say on the positive side, has been with the company for 6 years, and that customer signs 3-year contracts. We've got about a year and a half, maybe almost 2 years left on that contract, but they've re-upped the contract several times now. But bringing in additional sales, again, going out and hunting for sales so that we're not as dependent on a couple of key customers. So that's a risk area. Like I said, luckily these on the hosted side, customers sign 2- and 3-year contracts, and they have contractual commitments in those contracts.
Excellent.
So
Sean,
we've got to diversify that customer base more.
Great. And finally, I think we should end this on why Sean. Give us a little your 2-minute pitch on your history and why we should have comments and you run this company.
Well,
a little bit of what you did in the past.
This is well, okay. I always say luck's a factor. I don't care how hard you work and how smart you are. Luck's a factor. I had my fair share of lucky breaks, but this is my second major venture. My first company I started. I was CEO for 17 years and had a successful exit. That company created the modern day 911 dispatching system used all throughout North America, parts of Europe, and the Pacific Asia part of the nation. That company started in '83. I started that with my business mentor, and I was CEO until 2000. Had a successful exit in 2004, 2005, can't remember the exact year. Controlling interest was sold to Westview Capital Partners. And so I've lived through this metamorphosis you have in a technology software company. You start off as a very engineering-oriented company, a bunch of software geeks like myself building software. And at some point, now you built your cool software, but you sure as hell better go out and sell it. So transitioning from a technology-oriented company, engineering mentality, to a sales mantra, critical. And we're going through that right now with Conatel. So you had this very engineering-oriented development cycle for many years. Building the Apeiron network took years. It took the founder, Josh Plood, and his partner several years to build that network. And it's up and running today. It's very, very well tested. We'll run over 1 billion transactions a month through our national network, and this thing doesn't miss a beat. But now we're at that point where you've got the infrastructure, you've got the network, and we got sales, but we don't have enough sales. So, like I said, this year, 2021, is this metamorphosis of morphing into a sales-oriented company. I've lived that before. And it wasn't just me. I've had a whole team of people in my old company. There was well over 100 people in that company. So the key, I believe the key is going out and hiring people that are better, smarter, faster than you are, and putting that team together. So it isn't, as the cowboys say, it's not my first rodeo.
Thank you, Sean, so much. Again, the symbol is KTEL. And we were here with Sean McEwen, CEO of Conatel. That's it. So thanks for listening. Thank you, Sean.
Great. Thanks, Maj.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network and Maj Soueidan are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy, sell, short, cover securities in any company mentioned and may profit in the event those securities rise in value if we are long and fall if we are short. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.